Good evening, everybody. I'm Neil Campbell, the Chief Executive of Inspiration Healthcare. We came to the market last June through a reverse acquisition, and I'm going to talk a little bit about that, a little bit about what the company does, what the company ethos is. And as the Chairman just said, we're actually announced our results today. So the first annual results were announced today, and the first few slides are part of a presentation I've given to analysts and investors this afternoon. First of all, a disclaimer, but I'll quickly skip through that as we've already had a general one. Talking about a little bit about what we do. We're a healthcare company, we're a technology company. There's lots of healthcare technology companies out in the world today. The market is a huge market. But the area we focus on is neonatal intensive care and other intensive care. And just to put things in perspective, this picture here so it kind of shows a baby of around about 27 weeks gestational age, probably weighing around 750 grams. We treat babies down way below that, and I've got a wonderful photo from a clinician who's doing a clinical trial with one of our new products of a baby that was 23 weeks gestational age, so just over 3 months premature, and we hope that the products we provide can actually improve the baby's outcomes from even before their first breath of life and through their journey in the neonatal intensive care unit until they graduate and hopefully live full and healthy lives. We also do other products in surgery and adult intensive care, but at the moment this is our main focus and something that really drives the staff and the directors of the company to better things. The highlights of our year, we had a solid year, financial, operational and strategic performance, considering that we did a reverse takeover, which all the advisors told me was one of the most complicated things that you can do on the stock market. And I think me and Ian, my finance director, who's sitting at the back of the room, still have some of the scars to prove it. And certainly when it came to paying the checks to the advisors, we definitely felt the scars. Revenues were up 15%, and these were against a pro forma because it's very difficult to try and analyse two businesses together that have come together in this way. I'll talk about pro forma results rather than statutory accounts because the statutory accounts are slightly misleading as to how we can be compared going forward. Operating profit was up this year from 0.3 million to 1.1 million on a pro forma basis. Our critical care sales grew due to sales of more of our own brand products internationally. We've got a large international base and presence for a relatively small company, and I'll explain a little bit about that as well. We restructured our sales team, bringing two companies together with two sales teams trying to sell two product ranges. We've restructured those, and we've already started seeing the benefits of a better focus of our sales team, giving customer service and support to our end users. We have a strong balance sheet, mainly cash balance, and I'll go through some of those. And we've already started making good progress in 2016. The first two months are on plan. We didn't empty the order book at the end of last year and have a slow start to this year. We're still continuing our growth. This was a reminder to some of the people who've seen our presentations before, but the reverse transaction, for those of you who are not familiar with it, the way I describe it is we sold a private company, we bought a public company and floated on the stock market on one day. And that's effectively happened on the 24th of June last year. It was an all-paper deal. We didn't raise any cash in the transaction. We did a share swap from the limited company to the PLC of 5-to-1. So the original shareholders of Inspiration Healthcare Limited, of which I am one, at the time ended up with 83% of the company, leaving 17% in free float. Earlier this year, the Nomad did allow us to sell some shares. We had institutional investment interest, and also the chairman was interested in investing in the company as well. So we did release some shares to an institution to try and change our ownership portfolio and the chairman. Financial highlights of the year. As I said, revenues were up by 15% on a year-on-year pro forma basis. Operating margins increased from 3% to 8%. Gross margins on our product range, because we're slightly changing the mix, has increased from 44% to 46%. And I can explain a little bit about our gross margin model in the presentation, as you'll see how we started and where we've grown from. Earnings per share before the exceptional items and impairment of intangibles has increased to 3.4 pence. And at the end of the year, we ended up with 2.3 million cash in the bank. I won't go through the detail of the pro forma consolidated income statement, but it's in the presentation if you want to see it later. And again, I won't go through the consolidated balance sheet. Just to explain a little bit about the cash, the private company held around about £300,000 in cash when we completed the transaction. Inditherm plc had about 900,000 cash at the time of the transaction. And so we've actually generated around about £1 million in cash this year from the combined company. Something we're very pleased with, and you'll see how our cash profits do drop through into cash as we flick through the slides. When we started the business, we were a distributor, and as a distributor in our business, typically you will get a margin around 30 to 40%. Some of our margins are lower than that, some of them are higher than that, but as a distributor, 30 to 40% margins. If you develop your own products and your own IP, our gross margins in this industry, typically 65 to 70%, depending on where you're selling your products. Some companies can leverage that a little bit higher, some a little bit lower, but these are sort of average margins in our industry. We also benefit from a sale of spares, technical support contracts, service contracts, and emergency hires. Part of our business is a very patient-focused business, and we do emergency hire of medical equipment at short notice, and we charge a premium for that, and the margins we can acquire in there are somewhere between 50 and 85%. So that gives you a flavour of our margin blend. We have a low requirement for fixed capital. Our business is actually has around about a 20% working capital to sales ratio. As I say, we're cash generative. We've got 2.3 million in the bank at the end of the year, and $1 million of that was generated this year. Our net assets, including cash and intangibles, are less than 300,000. So you can see that we've got a low demand for capital. Integrating the companies this year has been a great challenge. The one thing that we really wanted to do was extend the ethos of patient-focused customer service throughout the company. In the limited company, we're very much focused on the patient, and we will do emergency hires of intensive care equipment, and we will do that through delivering equipment at 6 hours' notice. So a hospital or doctor will phone up and say, I have a patient presenting with an oxygenation problem or ventilation problem in intensive care, maybe swine flu or a car accident, and we'll deliver a piece of equipment to that hospital with a clinical specialist beside them within 6 hours of confirming that we have the equipment available and that patient will actually benefit from that equipment. We've merged our sales team this year and to facilitate future growth. We've given them a focus and put national sales managers in charge of the two divisions to gain that growth. We've changed our marketing, our branding to be able to encompass one large company as opposed to two smaller companies. We've prioritised our R&D. As you can imagine, two technology companies coming together, there's a lot of ideas around what the next products should look like in our R&D portfolio, and we've prioritised those to give us the best benefit that we think, not only in the short term but the medium to long term as well. We're a heavily regulated industry. We have to comply to different standards around the world through the FDA in the United States, the Medical Devices Directive in Europe, Shonin's in Japan, and the SFDA in China. And one thing that we've been doing this year as well with the large group is to actually bring our quality management systems from 2 different companies into one company, so we can have regulatory compliance for the whole group anywhere we wish to sell our products. That's been a very big piece of work for us, but we're pleased we've got through that. We've looked at our international distribution network. We've assessed it and restructured it where we've felt necessary to be able to get the biggest bang for our buck. We actually export to over 50 countries around the world, including China, Japan, the US, Russia, Australia, South Africa, and of course the main countries in Europe and the Middle East. We've also realigned our technical support. Our technology needs to be supported properly. Life support equipment, when you're dealing with a baby of that size, breath by breath, the babies may need less than 2 millilitres of breath to fill their lungs. And so our technical support team will actually service those life support machines to ensure that they deliver exactly what the doctors want. And not only that, across the new products that we acquired through the acquisition, our technical support team now can service all of those products. We've still got things to do. Our accounts, our ERP system needs to be aligned, and that goes to phase 1 next week. So Ian, as I say, our finance director's had a fairly busy month, not only doing the annual statutory accounts this month, but also getting the company aligned to be able to go live on phase 1 with bringing that together. So that's the plan for the remainder of this year. And we're going to remove the barriers for paying dividends. Inditherm as a PLC made losses, and so we have to do a capital reduction to apply to the High Courts for a capital reduction so that we can pay dividends should we be in a position to in the future. So that was a bit about the last year, but coming back to what we actually do. We sell new equipment, medical equipment, pioneering medical equipment. We sell equipment to hospitals for things that they've never done before. We pioneered cooling for babies that have had birth asphyxia, so maybe the cord round the neck, the shoulder presents first, or even the baby's passed meconium and inhaled it. That will actually potentially cause brain damage, and we pioneered cooling as a treatment with some fantastic doctors around the world. And so hospitals that have never ever cooled a baby would buy some equipment such that we sell. So that's our equipment sales in new. We also replace equipment, so hospitals and neonatal intensive care units and adult intensive care units would have ventilators and life support equipment. And we would sell our ventilators and life support equipment as the hospital replaces old, out-of-date equipment. So when the end of life, they'll replace it, and we pick up business that way. I've already mentioned our service and spare parts, so every time we sell a piece of equipment for the next 7 to 10 years, we will get service contracts and we will get spare parts business. And on top of that, we also have a strong recurring revenue stream through our single-use devices. We're not a capital equipment company. We sell single-use devices as well, and that mix means that we're less reliant on capital budget from healthcare systems around the world. Just to recap, we've had 11 years of unbroken profitable growth in the limited company before we became a PLC, and now as a PLC we've had our first year of profitable growth in an enlarged company. So that makes a total of 12 years profitable growth. I've mentioned our 24/7 emergency hire, which gives us genuine life-saving customer service. And cash generating. One of the things that when we set up the company, and I was one of the founding partners of the limited company, we didn't want to be overdrawn. We decided that we shouldn't be overdrawn. We started the company with our own cash, and in the 11 years before we became a PLC, we'd used an overdraft facility for 11 months, even through the downturns of the recession. So we've always looked after our cash and managed our business that way. The story, we started in 2003. Myself and my 3 partners, we put £5,000 in each. That was our stake money. In fact, I had to borrow £5,000 from my mum because I couldn't actually afford to sit at the table with my partners. RBS at the time very kindly matched that and gave us an overdraft, so we won't have a bad word said about Royal Bank of Scotland and their overdraft policies at the beginning of the century. And we started as a distributor of 4 product ranges from Atom in Japan, Accutronic in Switzerland, and a couple of American companies as well. By 2007, we'd grown our sales to 1.6 million, and we'd licensed the Tekatherm product, which is the cooling product for babies with an encephalopathy. Through to 2010, we saw the benefits of swine flu. Swine flu was very kind to us as a company. There's a benefit to that horrible disease for us, and we launched some other products. And through to this year, we're at £13.1 million sales. We've acquired Inditherm. We're prepared to launch more of our own products. We now employ 65 people and sell to over 50 countries around the world. Our market segments, most of our business is in critical care. I won't go through the detail on the slide, but around about just over 9 million or 70% of our turnover comes from critical care. That's adult intensive care, neonatal intensive care and paediatric intensive care. In the operating rooms, where we sell some of the thermoregulation products as well as distribute products for cardiac surgery and ENT surgery, it's smaller, but we feel with much greater potential, and that's just under 15% of our turnover at around about 1.7 million. And our home healthcare division, which is mainly distributed products, but we also have some of the old industrial products in there as well, just to balance and to have the 3 segments. It's 2.3 million and just under 20% of our turnover. When we started the company, we didn't have any cash. We never went out to venture capitalists, private equity houses. We didn't float on the stock market in 2003, so we only had our own cash. And we started with distributing products. And the journey that we had was distribute products which are fast to market because someone's already done the regulatory clearances, and we can just take those and sell them and move boxes effectively in its basic form. And that's very cash generative. We used some of the cash to reinvest in our business, and we took out longer term license agreements where we could have a little bit more control over the products, where we sell them, and we would improve our margins. And through the cash that we've generated in a bigger business, we've started developing our own products, which give us higher margins and total control of where we want to sell our products in the future. And as we carry on this journey in Inspiration Healthcare, we see ourselves spending more time at the right-hand side of the slide developing our own products, but certainly we won't forget where we came from and start looking at taking more distributed products if we actually find the right products that will add value to our sales team and our customers. 2016 outlook, we see continuing market strength. The market for neonatal intensive care equipment seems to be strong. People are still having babies despite a recession. We see product launches planned for this year, a couple of product launches. The RPAP is our resuscitation device, which, as I say, was used on a baby last week, a 23-week gestational age baby. And we see a low-cost version of our Tekatherm cooling device, which we hope to launch in the developing world, where we're partnering with, or we're participating in a large clinical trial that's being run by Professor Sudhin Thayal at Imperial College in India, Bangladesh and Sri Lanka, and we hope to be able to launch that product towards the end of the year. We've got an opportunity to expand our international footprint. We've got regulatory clearances for certain products, or more products going forward in Russia, China and Japan, and as we meet those regulatory overcome those regulatory hurdles in those countries, we already have the distribution networks and contacts to be able to sell the products going through there. And we've had a solid start to 2016. As I say, we're on plan so far, and given the cash on the balance sheet, we are very confident of being able to deliver our plans in 2016. The future for the company, longer term, we're going to continue our organic growth through our existing products. We feel that some great technology that we've got, and that great technology has got much more potential than where we are today. And we can therefore leverage our relationships with our distribution channels, our distribution partners around the world. As we take more products, we can feed those to those distribution partners to sell into their markets. We're going to continue to extend our strong relationships with academia. We're very privileged to have worked with the good and the great, especially in neonatal intensive care. And we really want to keep that relationship going, so we remain at the forefront of medical opinion and medical technologies in years to come. We're going to maintain our R&D focus. We're going to invest more heavily in R&D over the next coming years to develop our own branded products to be able to sell worldwide. When it comes to acquisitions, we have got some cash, and being a PLC, one of the attractions of being a PLC on AIM was we open up opportunities for capital markets. And if we do find the right acquisition at the right price at the right time, that's certainly something we will look at. And we want to create one inspiration. We've got a great brand that punches above its weight worldwide in terms of the way it's respected and the way we compete with some of the biggest household names in the world. We compete with Philips, we compete with GE, companies that people don't realise have a strong neonatal presence. And we do very well, and we want to continue to create that one inspiration brand. So in conclusion, we had a solid performance despite the major inconvenience of doing a reverse acquisition. It's been a great journey this year, and to be able to actually grow this year despite having done a very complex transaction was a great testament to the staff and the rest of the management team that I'm privileged to work with. We've got great momentum going forward this year, and our new financial year started on plan. We've now created a clear focus and a clear strategy for our medium to long-term growth, and our strong cash position will enable us to deliver on that. So thank you very much.
Any questions, anybody? Gentleman at the back there.
Is your future growth all expected to be within the neonatal segment that you're in? And could you talk a little bit about the existing or the current market share that you have, perhaps in the UK or other foreign markets you're in?
Yeah, in the short term, we see huge potential around neonatal resuscitation. The company that we bought, Inditherm, had a product called LifeStart, which actually allows a baby to be resuscitated next to the mother and father, if they're both in the room, with the cord still intact. So we can actually treat that baby from before the first breath of life. The first product out of our own R&D stable is the Inspire RPAP, and that actually gives the very first breath of life to a baby as well. So we do see a very big focus for our growth in that area. And coupled with other products that we also have where we see there's still potential to grow organically. So the neonatal is a big focus for us. We also have some other products that we acquired through Inditherm, which were surgical warming products for patients on the operating table. And they never really got traction in Inditherm, and we've looked very closely at the reasons why. And we believe there's 3 or 4 reasons why those products didn't get traction. Partly the product offering, partly the way that the commercial offering was put around and the way the product was promoted. So with our scale, more focus, better distributor management by just having more people being able to manage distributors, we feel that we'll get growth out of the surgical side as well. Market share is a really difficult one because it's very difficult to define exactly what market we're in. So I don't want to be.
About the opportunity for growth within the space.
The space is relatively huge. 10% of all babies require some sort of resuscitation at birth. There's 5 million babies born each year in the EU, 4 million babies born in North America, just to give you a flavour. So. And that's not the babies that crash when they're in the intensive care unit, just go down and need to be resuscitated to bring them back to where they were. So we're really scratching the surface. And I don't want to give misleading figures to say where we are, but when you consider that our neonatal sales are somewhere under £10 million, and the amount of money that's spent on neonatal intensive care equipment worldwide, we're really scratching the surface.
Time for one more question.
Thanks, Neil. One question around your IP. You mentioned that you have your own proprietary product and you have IP protection around that. How important is IP in this business, and how easy is it for competing businesses to R&D around that IP? And you mentioned the thermal product, to create their own thermal product.
Yeah, IP is always an interesting one. When do you patent something and when don't you patent it? And do you patent something in China, and have you got the money to actually defend it? I think it's very important to patent IP in the Western world. The biggest market for intensive care medicine for babies is the United States. And if you've patented your product in the United States and you protect it in where you can protect it relatively easily, you're probably going to discourage people reverse engineering it and copying it and trying to sell it elsewhere. So the EU and the US are key markets for patenting. We've chosen not to keep patents up in certain countries like China because we felt that a company of our size, we would never really be able to defend the IP, and the opportunity that we're losing probably isn't really worth defending. So we have got IP, we have got patents, but we do choose where to do that, because the cost of having a patent is one thing, the cost of defending it is another. And if you're not going to be prepared to defend your patent, why have the patent costs in the first place? Know-how, black art, or other IP, and the way we actually sell the product and the total proposition is very difficult to replicate for other people, especially in the UK, where we have this very strong patient focus, and therefore we win business and we differentiate without having the costs of formal IP protection. Does that answer the question? I can't remember what the end the last bit was.
That's fine. Thank you very much indeed, Neil. Thank you.
Thank you.
Thanks.